Well, I think that's all you need to know. This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets, and that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand. And demand is just silver or gold. I mean, we'll talk about silver first. Silver, there's no doubt about it. There is a liquidity squeeze. And in fact, in both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. I mean, it's obviously a little bit, but I mean, it's tiny, if anything. I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that, particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement, because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events. Silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought.
If it's not retail buyers taking this thing up higher, who is? Well,
this is the point, Danny. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets.
Yes.
And there was, actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in Shanghai rather suggests that the stand for delivery was of Chinese origin, or at least origin in that part of the world, and was known in that part of the world. I mean, I could certainly see, someone standing for delivery like that would be quite happy to talk to his chums, if you like, and say, guess what? I'm standing for delivery for $2 billion worth of silver. And I reckon that that's going to tip the market up, or whatever I say, but you can see how the rumor might start there.
Yeah.
And confirm, if you like, that it's Chinese sources who actually went for it. But the other thing that's fascinating is, was it just coincidence that A data center had to shut down because it was overheating. Now, I read somewhere by someone who is supposedly an engineering expert on cooling systems that data centers like that not only have one complete backup system, which automatically switches in if the principal one fails, but usually they have a backup to the backup. So this failure system is a bit fishy. So could it be that the powers that be just pulled the plug on the whole system while they tried to sort it out? I don't know. I mean, the problem with this is that, of course, we're not just talking gold and silver. We're talking about virtually the whole of the CME shutting down, if you like, by either having the plug pulled or through a data system fault. So it's all very mysterious. It really is mysterious. I mean, what I would say is that one of the primary functions of the system, the establishment, is to ensure that if something like this goes wrong, we are not to know about it at all. They will sit on it. They will claim anything to ensure that it doesn't leak out into the public that someone is in trouble. Because if someone's in trouble, we start worrying about this, that, and the other thing. I think we're probably beginning to do that anyway when we see the stands for deliveries. I mean, I haven't actually ahead of this looked at my numbers, but I think we're looking at about 12,500 tons of silver this year, 12,500 tons of silver this year, and roughly 1,200 tons of gold. I mean, these are huge numbers. The COMEX has turned out to be the largest precious metals mine in the world by, 3-4 times the largest mining nation. I mean, this is a staggering development. It really does.
What happened to that $2 billion order? Did it get fulfilled?
Well, no, it was a stand for delivery. Basically, someone bought the December futures. It's all on the December futures. And instead of closing the thing out and rolling it into the next one, which is normal practice, if you like, they said, right, come on, we want that stuff. Deliver, as they have the option to do. This is an extraordinary thing. It doesn't necessarily leave the CME warehouses, but the point is that the ownership changes and it goes into firm hands. It's no longer available as liquidity in the market, being registered for delivery. Comes out, that's it, tough. And in London, of course, there's no liquidity at all, which is why there's been that backwardations. And I think the reason that the backwardation has gone is principally because we're rolling over into the March contract now. So there is a time factor in there, if you like. I haven't actually done the calculation to see exactly what it sort of rather indicates in terms of, whether this is a backwardation once you allow for financing costs and all the rest of it. But, I think the point is that there are huge shortages everywhere. Whether it's COMEX or London is immaterial. And incidentally, also, the shortages seem to be in Shanghai because the silver stocks have gone down. I mean, they're under 600 tons now, which is seen rather as a Rubicon figure. I mean, if you go underneath there, you've got problems. It's also worth noting that from January the 1st, China is banning the export of silver. Now, that's interesting because China has been, in my view, the swing factor in controlling prices in the West until very, very recently. So if they're withdrawing from the market completely, there is no lid on silver, none whatsoever.
What's unfolding now suggests the long-standing gap between physical metals and financial contracts is nearing a breaking point. For years, critics argued that derivatives were used to suppress prices, but the current squeeze hints at the system turning on itself. Short sellers are refusing to deepen their exposure, while the small number of buyers entering the market increasingly demand real delivery, not paper settlement. The result is a dangerous stalemate. If enough contracts demand metal simultaneously, forward markets in London and futures markets in the United States may face unprecedented strain, potentially reshaping how global metal pricing is determined.
Well, I mean, in China, it could be a speculator, I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. Mm-hmm. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and proper. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move it's rather like, when you get a dislocation in the market, the price just goes crazy. We saw this with nickel on the LME, was it 18 months ago? In that case, it wasn't a shortage of nickel. There was a shortage of deliverable nickel, because the nickel had to be delivered, if you like, in accordance with what was required under the LME contract. And it was a Chinese nickel business which had loads of nickel, which it could have delivered, but not in that form. So it reneged on the contracts. And of course, the LME then had to sort of strike out any contracts that were taken out over that period. In the case of silver, it's different. It's not there. It is not there. It's gone. It's as simple as that. And of course, the other thing is that any industrial entity which has got a stockpile, is it going to let it go? In the past, it might have traded a bit, but under these circumstances, oh no, certainly not. We're going to hang on to our silver because we won't get it back if we put it into the market. So it's almost become it's a gift-in good. I've written about this a few times. A gift-in good is one which sort of upends the normal supply and demand relationship being sorted out by price. Price rises and, supply increases as a result. No, what's happening is that as the price rises, the supply is diminishing. And that's having a catastrophic effect as far as industrial users are concerned. And of course, it's only just beginning to catch the attention of people in the markets who are sort of thinking, should we speculate by buying silver? Should we buy silver ETFs? I mean, we saw Indian ETFs suspend operations back in the beginning of October because they couldn't get any metal. You can easily see the same sort of thing happening with ETFs in the West. SLV and so on and so forth. They may be forced to do that. I don't know. There's just no silver. I think that's the point, Danny.
A dramatic moment arrived when a massive delivery request, reportedly over 36 million ounces of silver and 58 tons of gold, hit the COMEX system. Rumors circulated through Shanghai before the West, suggesting the order originated in Asia. As the request entered the system, COMEX suffered a sudden data center failure, temporarily halting market activity. Engineers later noted that such facilities typically run with layered redundancies, making the official explanation unusual. Whether coincidence or crisis management, the event underscored how vulnerable derivative infrastructure becomes when large players demand metal rather than rolling contracts forward.
Let's take the first one, actually the last one you mentioned, the spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot, and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it and, premiums and things, we can trade this. They're not doing it because there isn't the liquidity to do it. Because, if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied directly to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock, short it, well, not short it, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on, which is one reason why I'm not at all keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, I mean, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. I mean, if derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market.
The strains are not confined to New York. London's liquidity has thinned, Shanghai's inventories have dropped below levels traders consider critical, and China is preparing to ban silver exports, removing a major balancing force from global markets. Industrial demand, led by solar manufacturing and advanced electronics, continues rising, leaving less metal available for financial markets. Even exchange-traded funds face sourcing challenges, with some in Asia suspending operations due to lack of supply. This dynamic resembles other commodity dislocations, but with a twist. Silver availability decreases as prices rise, defying normal supply and demand behavior.
I think the answer to that. I mean, I've been watching in London. We've got the largest silver mine in the world, actually, Fresnillo, listed on the London Stock Exchange, and it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price; it's behind the silver price most of the time, and it maybe catches up a bit the next day. The idea that correlates quite well with the silver price. The idea that investors looking to buy or sell Fresnillo, SLB, or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying, silver's the game in town, we've got to go for it, we're going to buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like.
So there's a lag involved when it comes to the mining stocks.
I think there's a bit of a lag, and I mean, basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly, it would be the investment community saying, silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver, and I've just explained why the market is short, et cetera, and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea. And he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers. Yeah, I mean, they've had commodities educated out of them. And apart from anything else, a commodity is not a regulated investment, and therefore it's verboten. Don't go there, mate, sort of thing.
Despite the tightening supply landscape, mainstream investors remain largely disengaged. Mining equities and metal-backed ETFs have not yet responded with the enthusiasm typical of a new bull cycle. Portfolio managers still favor technology stocks and familiar sectors, often overlooking commodities entirely. This disconnect creates a unique setup. Prices are rising due to fundamental scarcity and structural pressure, not speculative enthusiasm. If investment capital eventually recognizes the trend, a second, more powerful wave could emerge. Meanwhile, industrial users are hoarding supply, unwilling to release stockpiles into a market where replacements may be impossible to secure.
Well, I think that's all you need to know This is a squeeze on the system. China has gone out of the market completely. I mean, you can't arbitrage silver from China to sort out our markets, and that is if they were prepared to do it anyway. The squeeze is also in China. I think it's a global squeeze, and it's the result of over 5, 6, maybe 6 years of supply shortage relative to demand, and demand is just going off the scale with photovoltaic cells and all the rest of it. So silver it's being driven, if you like, by industrial means. There will come a point when the investment community wakes up and decides we better have some silver. I'm not going to speculate as to what their thinking might be. But at the end of the day, you can't resist a bull market in anything. When you see something going up, you might ignore it for a bit, but then there comes a point where you can ignore it no more, and you've got to go and buy some. We have yet to see that. And it's perfectly capable of taking silver. Well, I mean, we're approaching 60 as we are. I mean, spot is 58.3. 60 is a doddle this week, easily. I mean, that's not a forecast, but I wouldn't be surprised. 70, 80, 90, 100. I mean, this is equally possible. The other thing, of course, I'm going over to gold, which we need to move on to, is that what gold is telling us is that the whole fiat currency system is getting into deep trouble. What that means is, sorry, I interrupted you.
No, I was just going to say I have the gold chart up, but yeah, continue. Go ahead.
Yeah, I mean, the point to understand is that over long periods of time, the purchasing power of gold is stable. I mean, things change and so on and so forth, but it's been the case really going all the way back in history. I mean, the thing about gold is that the above ground stocks have tended to increase more or less in line with the global human population. I mean, we've got records that go back, quite a lot of it estimates, but sort of sensible estimates, and we can see that relationship. And not only that, it is embodied in all our laws that it is real money, final settlement, expunging all counterparty risk. That's the important point. And it doesn't matter what the US Treasury says, whether it's a pet rock or whatever. I mean, they're just promoting their own fiat currency instead. But the fact of the matter is that in everyone's common law, gold is money, and it is a stable form of money, and has been and will continue to be through millennia. So when we see the gold price rise in 1971 from $35 to currently $4,234 as we speak, I mean, that's not gold rising, that's the dollar declining. The idea that you can measure the dollar's decline by looking at consumer price index and all the rest of it, well, that gets fiddled, as we know. The best indicator that you can possibly have, not perfect, is what is the exchange rate between dollars and gold. Now, the interesting thing, Danny, is that when you look at expectations, if you like, amongst economists and also portfolio managers, they think that inflation is becoming less of a problem in 2026. They think the purchasing power of the dollar, it might drift back towards the 2% target, but basically they don't see it going up. What gold is telling us is no, that's wrong. The purchasing power of the dollar is going to decline, which put another way means the consumer price index is going to start rising, and probably quite sharply. And we can see that. Now, the reason that the consumer price index will start rising is because the purchasing power of the dollar will be declining. We are losing confidence in credit. Now, I know many economists, most economists perhaps, think that currency isn't credit, but oh yes, it is. It appears on the central bank's balance sheet as a liability. It is credit. It is the liability of the central bank. And we know that most of these central banks, including the Fed, by the way, have obligations greater than the assets to back them in terms of value. They just don't choose not to mark things mark to market. Basically, if the Fed was a private sector industry, the directors would be in jail now because they'd be trading well bust, effectively. We know what the situation is. We can see how the debt is racking up even further. And when that happens, bond yields rise. And as bond yields rise, what happens to equities? The equity bubble goes pop.
Yep.
And when the equity bubble goes pop, then what does the Fed, what does the US Treasury do? It rescues everything it possibly can, because that is the mandate. In other words, what we're going to see, what gold is telling us, is that the conditions that are evolving now are guaranteed to lead to the debasement of the currency, of the fiat currency, big time. So everybody's expectations that inflation is not going to be a problem in 2026 is so far wide of the mark. And I don't know of anyone who's looking at inflation in 2026 and saying, this is going to rise and rise and rise. But that is what the outcome is. That is what gold is now telling us.
Gold's breakout signals more than a market rally. It's a referendum on the stability of fiat currencies. Historically, gold preserves purchasing power across generations, rising when confidence in credit declines. With public debt at record levels and major central banks carrying balance sheet losses they cannot mark to market, faith in the system is eroding. Markets anticipate easing inflation, but gold signals the opposite, a renewed decline in currency value driven by swelling deficits and rising interest costs. As bond markets weaken, equities lose support, prompting interventions that further dilute purchasing power. Gold's rise is not speculative. It's a warning that the monetary order is shifting,